Hello, merchandising is one of the largest and most influential industries worldwide. In this video, you will learn the basics about reporting merchandising operations. In fact, a merchandising company is a company that buys goods and then resells them, generally for a higher price than they were purchased. There are two types of merchandising companies: retail and wholesale. A retail company sells products directly to customers, where a wholesale company buys items in bulk from manufacturers and resells them to retailers or other wholesalers. So here, the primary source of revenue is through buying and selling goods. Usually, the operating cycle of a merchandising company is longer than that of a service company. A merchandising company engages in the purchase and resale of tangible goods. However, service companies primarily sell services rather than tangible goods. So the purchase of merchandise, inventory, and its eventual sales lengthen the cycle. As you can see in the figure in front of you, in a service company, we don't have inventory. And this is where the operating cycle for merchandising company becomes longer than that of a service company. Here we will see how to measure income in a merchandising operation. The primary source of revenues is referred to as sales revenue or sales. So imagine here we're selling bottles of water and we are selling 5 bottles of water. And the price of each bottle, it's $1. And the cost, it's 50 cents. So here the sales revenue, it's 5 times 1, so it's $5. Then we're having the cost of goods sold, which is the total of cost of merchandise sold during that period. And here we're having 5 bottles, and each bottle it's $0.5. So it's 5 times 0.5, so it's $2.5. So here we arrive to the gross profit, where it's the sales revenue minus the cost of goods sold. So 5 minus 2.5. So the gross profit is $2.5. Then we're having the operating expenses. It means the salaries and wages that you pay for the one who's selling these bottles. And also you might have the electricity and the water in order to make the shop operational. So let's consider that the operating expenses in this store, it's $2. Finally, we arrive to the net income, which is $2.5 minus $2, so it's $0.5. And here we're having a net income. In case the result was negative, it means we're having a net loss. All merchandising companies have to have some type of system to keep up with their inventory. They have two options to choose from: a perpetual system or periodic system. A perpetual system maintains detailed records of the cost of each inventory purchase and sale. It records continuously and shows inventory that should be on hand. And also the company determines cost of goods sold each time a sale occurs. Perpetual systems are ideal because they give you actual inventory counts at any given point and time. But they usually have a very expensive initial cost to implement. So traditionally, they are used for merchandise with high unit values. However, now with technology, perpetual inventory, it's becoming easier to implement. The second option that we might have, it's the periodic system. And it's a system that updates inventory at a specific point in time. So it does not keep detailed records of the goods on hand. And the cost of goods sold determined by count at the end of the accounting period. And here we will see the flow of cost for a merchandising company. So first we're having the beginning inventory. Then we add the cost of goods purchased, which will lead us to the cost of goods available for sale. Those goods that they are not sold by the end of the accounting period represent the ending inventory. And goods that they are sold, they are assigned to cost of goods sold. Now, under a periodic system, in order to calculate the cost of goods sold, we will have an example. Let's assume the beginning inventory we're having, it's $100,000. And we add the purchases, and here they are, $800,000. So the cost of goods available for sale, it's $100,000 plus $800,000. And at the end of the period, if we counted the inventory we're having, we will have the ending inventory. And here we have it, $125,000. So in order to have the cost of goods sold, it's the goods available for sale minus the ending inventory will lead us to the cost of goods sold. And here it's $775,000. When recording purchase of merchandise, we have to consider that it's made using cash or credit, it means on account. Normally recorded when goods are received. And purchase invoice should support each credit purchase. So here we are talking about the supporting document, because every journalizing or every recording, we have to have a supporting document. And here it's the invoice. In order to illustrate how we can record the purchase of merchandise, we consider that Sam's Appliances, which is the buyer, and here it's important to know who's the buyer and who's the seller and for whom I'm recording. So the buyer uses as a purchase invoice the sales invoice prepared by ATV Supply Incorporation, which is the sellers. And the invoice is dated on the 5th of June. The invoice total is $3,500. We are asked to prepare the journal entry for Sam's Appliances for the invoice from ATV Supply. You can think about it and pause the video and then try. So here we are having $3,500 of inventory that they are entering Sam's Appliances inventory. So here the inventory, it's debit $3,500. And since Sam's Appliances didn't pay cash, it means it's on account. So it's accounts payable, $3,500. Now also, when recording the purchase of merchandise, the sales agreement should indicate who, the seller or the buyer, is to pay for transporting the goods to the buyer's place of business. So we might have two options. The first option is FOB shipping point, where seller places goods free on board the carrier and buyer pays freight cost. As you can see, the ownership passes to buyer at the seller's business place. And here the buyer, he will be responsible of the transit. The second option we might have, it's FOB destination. The seller places goods free on board to the buyer's place of business, and seller pays freight cost. Also, you can see that ownership passes to the buyer at the buyer's place of business. So here, The seller is responsible of the goods in transit. Freight costs incurred by the seller are an operating expense. In order to better understand the different FOB that we're having, whether it's destination or FOB destination or FOB shipping point, we assume upon delivery of goods on June 5th, Sam's Appliances pays Express Freight Company $150 for freight charges. The entry on Sam's Appliances books is. So here we have to know Sam's Appliances is the buyer. And since he's paying the freight cost, it means it's FOB shipping point. Why? Because he's the buyer and he paid for the shipment or for the transportation. So here, the value of the inventory is increasing by the freight cost. So inventory, it's debit 150, and since he paid, it means cash, it's credit 150. The second option we might have that ATV Supply, which is the seller, pays the freight charges. And here we have to see what's the entry that it should be made by ATV Supply. Since ATV Supply is the seller and he's paying the freight cost, it means here we are in FOB destination because the seller is paying for the freight charge. And as we said previously, when recording freight cost incurred by the seller, they have to be under operating expense. So here we're having it as expense, freight out expense, debit 150, and since he paid cash, ATV Supply, it means cash 150. Now, in order to continue and to see how the purchases of merchandise are recorded, we're having one case that it could be returns and allowances. So here, purchaser may be dissatisfied because goods are damaged or defective, of inferior quality, or do not meet specifications. So here, the buyer could return these goods under the purchase return. So return goods for credit if the sale was made on credit, or for a cash refund if the purchase was made for cash. Or he might ask for a discount or allowance. So here he may choose to keep the merchandise if the seller will grant an allowance from the purchase price. And here we will have an example about Sam's Appliances. This is the initial transaction that we were having based on the invoice from ATV Supply. Imagine that one microwave worth $200 was defective and he wants to return it to ATV Supply. So what will be the entry here? As you can see, the inventory, it's decreasing because we returned one of the items. So inventory will be credit $200 and our accounts payable will decrease by $200. This is why the accounts payable also will be debit. So accounts payable debit because the accounts payable, they are decreasing, and inventory will be credit because the inventory are decreasing as well. Purchase discounts. They are credit terms that may permit buyer to claim a cash discount for a prompt payment. And it's having advantages for both the purchaser and the seller. For the purchaser or the buyer, it saves money because he's having a discount. For the seller, it shortens the operating cycle because he's encouraging the buyer to pay in a shorter period. Some examples about the discounts, we might have, like here, 2, 10, and 30, which means 2% discount if paid within 10 days. Otherwise, net amount due within 30 days. Or we might have 110 EOM, and EOM, it stands for end of month. And here it's 1% discount if paid within first 10 days of next month. And it could be N10 EOM, it means net amount due within the first 10 days of the next month. And here we don't have a discount. An example to illustrate how we can record a discount when we are purchasing merchandise. So we assume Sam's Appliances pays the balance due of $3,300, which is the gross invoice price $3,500 less the allowances $200. So the last June 15, it was the last day of the discount period. So here, in order to prepare the journal entry for Sam's Appliances, knowing that the terms it was 210 and 30, it means because he delivered, ATV Supply delivered the items on the 5th of June, so Sam's Appliances is having 10 days, and 10 days, it's the 15th, so this is why it was the last day of discount. So he's eligible to 2% discount. First, we have to calculate the discount amount. The discount amount here, it's 2% times 3,300, so it's $66. It means Sam's Appliances will pay 3,300 minus $66 in cash. And all the accounts payable will be decreased. So here, accounts payable, it's debit because it's decreasing 3,300. And we're having the inventory, it's credit because the value of the inventory decreased because I'm paying less for this inventory. And I'm paying 3,300 minus 66. It means 3,244. Here, if Sam's Appliances failed to take the discount and instead made full payment of 3,300 on June 20, the journal entry would be, it's simple. Here, because Sam's Appliances, it's not eligible for a discount because it's after 5 days of the discount period. So he will pay the invoice in full. So here, he will pay cash, 3,300 credit, and the accounts payable will be debit 3,300. Thank you for watching this video. I know it's having too many details, but you can, if you're having any question, leave it in the comments below. In the other part of this video and in another video in the future, I will explain how we can record the sales of merchandise. So thank you for watching and stay tuned for future videos.